Hi, Triple Brain here. Welcome to the channel. In this video, I will discuss the concept of technical analysis and provide an unfiltered and honest assessment of this investment strategy. The intent of this video is for educational purposes and to offer insight into the pros and cons of technical analysis. So let's see what's on the menu for today. For starters, I will briefly discuss the burgeoning genre of technical analysis videos on YouTube. Secondly, I will provide a detailed review of technical analysis that concentrate on the disparities between short-term and long-term technical analysis. In the process, I will also evaluate the level of risk exposure for each. Lastly, I will perform a short-term and long-term technical analysis on Dogecoin. Here's what's going on. Lately, I've seen a growing number of content on YouTube demonstrating varying capacities of technical analysis on different securities. But there are far too many misconceptions about technical analysis that are unaddressed and further misconstrued as more content is produced in this category each day. People are feeding off this misinformation, trading on these intuitions, and the outcomes are really no better than a wild card. With that being said, the objective for this video is to provide some insight into the nature of technical analysis so that everyone can make sound investment decisions and increase the longevity and fullness of their portfolios. More importantly, I want to put it out there that technical analysis is by no means a guaranteed strategy for achieving profits. I've seen many financial gurus that package technical analysis courses as some sort of trading secret, when really just about anyone with access to internet can learn it for free. There are content creators out there that inadvertently or purposefully create the illusion of being a genius technician by making predictions of price action throughout the day and getting them right nearly every time. But the reality is that they are making price action predictions that are highly probable by taking advantage of statistical parameters like standard deviation, time intervals, and margin of error to cushion against errors in the prediction. This will create the impression that they can make accurate predictions every time, which could have catastrophic repercussions, especially for new traders taking on risky trades thinking that the market is easily timable and predictable. But by no means is this video made to discredit the competent and credible investors that put the extra effort to perform real technical analysis without taking advantage of statistically probable events. I think when it comes to implementing effective technical analysis in your investments, some of the best advice that you can get on a free platform like YouTube are from content creators that are savvy with both technicals and fundamentals. By pairing the technical indicators with the financial metrics of fundamentals, we can cross-validate the true performance of a company and develop a substantiated price target to gauge the value of a security. Also, I want to note that making inaccurate predictions are normal and are a great learning opportunity. Even investment strategists and professionals in the finance industries with decades of experience often deliver inaccurate readings. But the key to being successful is to acknowledge these mistakes and learn to trade with greater discipline. The most important thing is to rely on your own due diligence, validate your research, and create an exit plan. Here's my take on technical analysis. I think that technical analysis is at best a useful tool to observe stock market psychology. That is, the buying and selling behaviors of market participants of specific securities in designated timeframes. It's a beautiful tool to track fluctuations in supply and demand. Keep in mind that technical analysis is designed primarily to evaluate price actions on securities, but it is not an ideal tool for measuring the true or intrinsic value of a company. That's what fundamentals are for. This is due to the fact that the metrics of technical analysis are rooted in statistics. It's merely a tool to observe the probability that a price action event will occur and lacks the financial substance that fundamental analysis is founded on. A watered-down example of technical analysis is trying to predict how high a rocket will fly by checking weather conditions and referencing a data log of previous test flights. The technical approach is based on the assumption that under a set of repeated and defined circumstances, the rocket will reach a predictable height. On the other hand, with fundamental analysis, calibrated variables such as fuel tank capacity, burn rate, trajectory, and aerodynamicity are considered in the calculation. This approach is based on the mathematical limitations of the rocket's engineering, which is likely to be more dependable. In other words, technical analysis concentrates on circumstantial factors and time-tested events that might contribute to price movement, while fundamental analysis concentrates on the fiscal performance of a company to determine an intrinsic value of the company. Therefore, both methodologies will produce distinct values for the same security. So just remember, the next time you're planning to use technical analysis to evaluate a security, make sure you also incorporate fundamental values to get a proper assessment. The marriage of both technicals and fundamentals will always be better than using just one or the other. Now, despite the apparent drawbacks of technical analysis, it's still an important accessory of due diligence. The common misconception that I hear a lot is that the technical approach is only useful for day trading, swing trading, or short-term investments, when in fact, it's far more effective for building long-term positions. This might sound counterintuitive because technical analysis can track variables that fluctuate daily, such as volume, RSI, moving averages, charting patterns, among others. So then in theory, it should be perfect for someone that is looking to make a quick and profitable trade. However, using technical analysis for short time frame trades are unbelievably risky. The odds and level of risk are equivalent to gambling at a casino. Oftentimes, shorter time frames can develop misleading charting patterns that appear to have the classic shapes like the cup and handle, the ascending and descending triangles, and the good old head and shoulder formation. But because these patterns have not yet matured over the typical time frame of months to years, it can put day traders and swing traders in a very tough situation if the price movement shifts in the opposite direction without warning. I'll explain. Technical analysis for short-term trades is like forecasting daily temperatures in an area with polarized weather patterns. One day it's perfect beach weather, and the next day it's hailstorms and heavy rain. This is evidently true with many small-cap stocks, penny stocks, illiquid or over-the-counter securities, and volume-deprived tickers that can easily shift multiple percentage points within the day or week. Just look at any short-term 5-minute, 15-minute, or 20-minute chart, and you'll notice erratic movements in just about any stock. But when you zoom out to a longer-term daily or weekly chart that spans 4 to 8 months on the charting window, you'll notice a completely different price action pattern. Where short-term charts might show descending triangles, bull flags, and triple top formations all in one day on the same stock, long-term charts might show a more gradual, mature, and defined charting formation. Timing micromovements in short intervals using technical analysis is very difficult because daily resistance and support levels are crossed multiple times a day, making them unreliable. Predicting these short-term movements is like setting a GPS location and trying to predict every turn and every exit on the trip, when it's much easier to predict the general direction of the destination. The odd thing is that most short-term traders using technical analysis for their trading decisions already understand the risks involved. They know that short-term technicals are betting purely on the activity of the market, and they also know that these micro patterns that usually look like the classic charting patterns are only temporary and often don't follow the usual course. But many of these short-term technical traders are often too engulfed by the thrill of trading, and they throw sound investment strategies out the window. The counter argument to this would be, what if I invest in a large cap stock with low volatility and stable volume? And the answer to this is yes, technical analysis for these stocks would present lower risks, but the short-term investments in such securities have a high opportunity cost, high risk of return profile, and still run the risk of unrealized losses that can take months or even years to recover. This is exactly why I'm making this video, to show that technical analysis for short-term trades induce high risks to a trader's portfolio. Yet there are so many content creators on this platform that are performing intraday or short-term technical analysis on securities that are far too volatile to be an appropriate candidate. The risks are phenomenal here. 1 or 2 lucky day trades using technical indicators do not promote long-term growth, and in fact creates a false impression and a positive reinforcement that it's easy to day trade or swing trade using technicals. The likelihood of losing big or accumulating big losses over time will sneak up on many of these traders, so be a wise investor by doing fundamental analysis to substantiate your projected patterns. For reference, here's a 1-minute chart of Tesla's price activity. What you should notice immediately is how bumpy this chart looks. The repeated pivoting of the price from positive to negative price action makes it nearly impossible to get an accurate reading in such a short time frame. It doesn't matter if you're using volume, trend lines, Bollinger Bands, or RSI for your analysis. None of these variables will produce an accurate reading because of the erratic price behavior. And this reflects perfectly just how turbulent the market is on a day-to-day basis. Shifting your attention to the daily charts of Tesla, which puts about 8 months of price activity in frame, and now you have a completely different perspective of what's happening. The chart is much less jagged, the pivoting of price movements are more subtle, and there is more defined charting patterns in view. We can also see how Tesla is moving very nicely along the Fibonacci support and resistance areas and developing a bull flag with consolidation between February and March, followed by a rising wedge or ascending triangle from March to May. On a separate note, I mentioned earlier that it is not too difficult to perform short-term technical analysis and achieve high accuracy doing it. But how can this be possible when I just explained why technical analysis is not the ideal approach for short-term trades? Well, it's all about the margin of error. If I wanted to give off the impression that I can predict intraday moves like I have an exclusive backstage pass to the New York Stock Exchange, I can make predictions that are 1 to 2 standard deviations away from the average daily price movements. For example, if I examine a hypothetical stock XYZ for 1 month and I notice that the average daily moves are between plus or minus 1.5% with a standard deviation of 0.5%, I can safely predict that the intraday price will not exceed 2.5% in either direction. This prediction represents a price movement that is 2 standard deviations from the daily average, which means that there is a 95.5% chance that the price movement will be in my projected range. To put this into perspective, if stock XYZ is a $10 stock, a 1% difference from the average move is only 10 cents, which gives me the ability to make guesses that appear to be very precise when really it's just taking advantage of statistical probabilities. In the same manner, you and I can both predict the gas prices at our local gas station with very high accuracy by suggesting that the price won't change by 25 cents per gallon the next day. The moral of the story is anyone can make an impressive streak of predictions for stocks, but it only takes one bad trade to ruin a portfolio. On the flip side, long-term technical analysis for long-term trades is an effective form of diligence to set up well-timed and well-positioned trades with a good probability of success. This is largely due to the fact that erratic buying and selling behaviors are muted over longer durations by the formation of mature and defined charting patterns. The curbing of these volatile micromovements in a long-term chart makes investing much more safe and helps traders to avoid falling into the pits of sudden volume pressures that can pivot either way within minutes to seconds. This is due to the fact that time is a decisive component to any investment. Given enough time for a position to mature, the likelihood of achieving a profitable trade is substantially higher than a short-term trade because prolonged exposure gives more opportunities for catalytic events like new product developments, partnerships, and positive outlook statements. Of course, prolonged exposure to a position may also have an adverse effect because investors run the risk of missed expectations on earnings, liquidity issues, operational and production delays, among other things. But if proper diligence of a company's fundamentals, potential catalysts, and pipeline product developments were studied in advance, then it's unlikely that a financially and structurally fluid company will run into these problems. That's why, as boring as long-term positions sound, it really is much of a safer investment than day trading or scalp trading. Going back to my previous metaphorical representation that short-term technical analysis is like attempting to forecast daily temperatures in a place with erratic weather, long-term technical analysis would then be equivalent to forecasting the climate in that location. Because climate measures the average temperature in the region over long intervals of time, it is a much more stable and reliable indicator to predict temperatures in an area. Any severe short-term weather events will be masked over time by average temperature conditions across months of observation, just like how large and spontaneous price actions of securities become masked by consecutive months of gradual pattern developments on a chart. The thing is, technical analysis over long intervals is also very forgiving of misreadings. Let's say I misconstrued a bearish indicator as bullish, and I purchased the security at a high price. After 3 days of holding, the security plunged following damaging news of production delays. At this point, my short-term technical analysis using the 15-minute chart is completely out the window, and I changed my prediction that this stock will drop further in the short term. But when I switched to the daily charts, I noticed that this price plunge has fallen to a solid support level right above the 200-day moving average. At this point, the RSI is also approaching oversold levels. Well, the perspective now is completely contradictory to the 15-minute charts. Now, I might just decide to hold onto the stock instead of realizing the losses because it might be a cusp of a rebound. This would be an example of how short-term technical analysis requires extreme precision that practically is impossible to really master, whereas long-term technical analysis provides an aerial view of the price performance that is much easier to predict and provides a lot more to make modifications and adjustments to a position. Needless to say, short-term technical analysis and short-term trades are often only effective when it works, and it looks very impressive when it does. But consequently, traders become desensitized to losses because they're often looking for a quick home run play. The reality is that there is no definitive way to predict the market, and your best bet is to run a combination of primarily long-term positions for compounded growth and some short-term positions to increase market exposure. So, the question is, why do people still day trade using short interval technicals when it's so risky? Well, part of the reason stems from the belief that algorithm traders execute trades using automated computer programs with defined technical parameters. These parameters might be a certain percentage movement in the underlying, a specific RSI value, a trading volume, or a specific time of the trading window. It's important to note that algorithm trading accounts for a majority of the trading activity in the stock market. That is, the volume of shares traded daily is likely derived from an algorithm trade. This is because investment firms like hedge funds, pension funds, banks, institutional investors, the so-called whales of the market, all use algorithm trading as a standard practice to execute high-frequency trades that would otherwise take too long to execute manually. This gives algorithm traders a significant time advantage to get in and out of trades, especially in moments of volatility and price action. It's becoming an incredibly complex instrument for investments because the integration of AI technology helps to maximize trading efficiency and outcomes. In this case, for the average retail trader, it would make sense for them to follow the lead of algorithm traders by predicting these defined parameters. The only problem here is that it's impossible to consistently predict what types of parameters algorithm traders are using in their trade execution models. There's also the issue of having too many algorithm traders participating in the market, each of them having their own positions in different securities and each of them defining different parameters in their own trade execution models. So the notion of being able to predict short-term market movements using technical analysis is simply not true. The second reason why people day trade using short interval technicals is simply due to a false cause fallacy, or post hoc fallacy, which reinforces unhealthy trading behaviors like gamifying the stock market, becoming addicted to trading, and believing that the stock market is predictable. The false cause fallacy is really just a statistical phenomenon that influences the psychology of many retail traders because it creates positively reinforcing situations that create the impression that the market is predictable. The famous line that correlation does not equal causation most accurately defines the false cause fallacy. A common example of this in technical analysis is correctly predicting the direction of price movement for a security by observing volume and RSI, and then assuming that volume and RSI directly contributed to this movement. The issue here is that there could be many underlying parameters resulting in this price action, but in the eyes of the trader who observed volume and RSI alone, they are positively reinforced by the outcome of their prediction. Alright, here's the fun part of this video. I'll perform a short interval and long interval technical analysis on the same security for comparative purposes. This will be for Dogecoin. The objective of this is to demonstrate that technical analysis can often produce mixed results depending on the types of indicators that you're using to assess these charts. Under most circumstances, people use a combination of 3 to 4 parameters or indicator types to perform a technical analysis. The most common ones are trend lines, charting patterns, and RSI, which are the metrics that I'll be using today as well. You see, the issue with technical analysis is that it's a bit of a catch-22. If you use too many indicators or parameters, say 4 to 5, you will likely produce conflicting signals that can be interpreted as both bullish and bearish. But if you don't use enough indicators or parameters, you'll likely end up missing an important signal that might point towards a different outcome. That's why technical analysis is so difficult to perform accurately, because there's simply too many factors that can move a stock price in a certain direction. Here I have the price action for Dogecoin using a 15-minute chart. This is a highly requested security for technical analysis, and I personally think technical analysis is great for crypto because they lack fundamentals like assets and fiscal structure to back its valuation. Crypto is really a reflection of the real-time supply and demand psychology, which technical analysis is perfect for. Bear in mind that the video is delayed, so the prices you see are not current. So in purple, I'm using a Fibonacci indicator, which is a crowd favorite because it's an algorithm-derived indicator that predicts support and resistance levels using the golden ratio. This is a quantitative indicator that is sometimes treated like a window into algorithm trading because it's easily programmable into algorithm trading softwares, and if used correctly, it can result in a very profitable trade with optimal entry and exit points. However, the drawback here is that this is just an assumption. The reality is that most algorithm trading involves complex strategies of trading conditionally, with some having greater sensitivity to certain variables than others. The execution of algorithmic trades are therefore extremely hard to predict simply by using Fibonacci indicators. Moreover, Fibonacci indicators are more of an art-based concept that involves ratios that are appealing to the human eyes in psychology. It really is more of a psychological indicator, if anything, but I still use it because it often does a good job with identifying support and resistance points. Moving on to the yellow indicators, I'm using trend lines to identify the general direction of price action. For someone that's new to technical analysis, there's usually two things that come to mind. One, surprise at how accurate the trend line fits the chart, or two, unimpressed because it looks like anyone that can connect two lines together can do this. The truth is that you don't really need a paid technical analysis course to learn this. The standard approach, which I demonstrate here, is to identify the relative peaks and dips. These are called the inflection points. These are the areas where you see a clear change in the slope of the charts from negative slope to positive slope or vice versa. And for short interval analysis, you'll likely see many of these inflection points. Keep in mind that you don't need to find the lowest point or the highest points. Even a small dip or a small peak are considered as relative inflection points. Once you've identified the inflection points, start a trend line point at the base of an inflection point, then extend the trend line across the chart. Try to find the right angle to hit as many relative peaks and dips as possible. This is the same thing a statistician, data technician, market researcher, and scientist would do when assessing graphical data points. In my technical analysis, in the short time frame that I assessed, I identified a clear bearish channel with descending price action, followed by a clear bullish channel with ascending price action. These conflicting signals in this short time frame is incredibly difficult to predict. However, if this pattern was observed over a long time frame, that would be more justifiable because stocks have a tendency to rebound or consolidate when it's oversold or overbought, or perhaps some catalyst or bad news is reported. But there's very little indication to justify these price movements going from a clear negative signal to a clear positive signal within 24 hours where nothing significant has happened. Moreover, the problem here is that the more inflection points there are, the greater the volatility, which means it's harder to assess price action. But based on the bull flag and bullish pennant paired with a low RSI, the short-term charts favored a continued bullish movement. Quick disclaimer here. Most charting patterns like bull flags, pennants, wedges, cup and handles, head and shoulders are used very loosely if not improperly. These patterns need to be formed and observed across long time intervals, typically half a year to a year. Otherwise, the patterns that form intraday or across days are only just price action. However, there is some validity in studying price action because there are psychological trading behaviors that repeat when certain price action patterns appear. It's important to note that investing on price action is much riskier and usually produces unfavorable trading outcomes. In this window, I have a daily chart observing price action between mid-March to mid-May. This is still not an ideal time frame for long-term technical analysis, but Dogecoin's meaningful price action only recently occurred in this trading window, so I'll work with what I have. Here, I have horizontal support and resistance lines that predict critical exit and entry points. Like trend lines, support and resistance lines attempt to connect as many inflection points as possible, but using only a horizontal line. The overall price action, using the consolidation channels and rising wedges as justification, is indicative of a bullish trend. I see successive highs being established, following by a healthy consolidation. However, this is where things get tricky. Looking at the RSI, which measures buying and selling activity, there is a clear indication of lower highs forming within the highlighted circle. In other words, selling pressure is outpacing buying pressure, causing the RSI to dip. In the same time frame, we see the price of Dogecoin establishing higher highs with each rising wedge. This negative correlation in the price and RSI direction suggests that as the price of Dogecoin is rising, there is increased selling pressure, perhaps from profit taking, triggering of selling limits, and corrective selling. This also means that people are likely paying at the top to take a position while early birds are exiting, leaving heavy bags for those that entered in the 60 to 70 cent range. This is also called an RSI divergence, which is a bearish signal that is masked by positive price momentum. One way to look at this is that there is so much volume piling into this currency, creating FOMO and price momentum, it's driving higher highs on the chart, but the net exchange of hands are from sellers to buyers. So in the daily charts, we are getting two major conflicting signals. The positive signal comes from charting patterns, while the negative signals come from RSI. In this case of Dogecoin, both the short and long-term technical analysis produces conflicting signals. I'm sure if I added more parameters for assessment, the results would be even more convoluted. So when I made this video back in mid-May, I didn't get a chance to upload it, but it's about 4 months later today, and it looks like the short time frame technical analysis lost to the long time frame technical analysis. From the 15-minute trading window, there was a very clear bullish signal forming, but shifting over to the daily trading window, which showed the negative correlation between price and RSI, there was a very clear bearish signal. Looking at the chart today, we see that following its April highs, Dogecoin's value depreciated significantly, leaving many of the sellers at 70 cents very happy, while buyers holding the bag for what looks like a long time to come. And that concludes the video on the truth behind technical analysis. I hope that everyone learned a thing or two from this video, and I'm always looking forward to hearing your feedback and suggestions on how I can improve the content. Thank you all for watching. Don't forget to like, comment, and subscribe. See you on the next one.